Imagine buying an ordinary company for less than the price of a used car, and decades later, that single decision becomes the foundation of one of the most valuable businesses in history. Now imagine becoming one of the richest people on earth without inventing a smartphone, creating a social media app, or launching an AI startup. No flashy product, no viral marketing, no overnight success. It sounds impossible, yet one man did exactly that. While the world chased the next big trend, Warren Buffett sat quietly in a small office reading annual reports and buying businesses that everyone else ignored. Many people thought he was too slow, too conservative, even outdated. But year after year, markets crashed, bubbles burst, and trends disappeared. His wealth kept growing. Today, Berkshire Hathaway is one of the world's most valuable companies, and Warren Buffett has built one of the greatest wealth creating machines in history. But here's the real surprise: Buffett didn't just become a billionaire, he became a brand. Millions of investors study his decisions. CEOs hope he invests in their companies. His annual shareholder meeting attracts people from across the globe, and even a lunch with Buffett once sold for millions of dollars at auction. So, how did a newspaper delivery boy become one of the most trusted names in global finance? And why do his ideas still matter in a world obsessed with speed? To understand that, we need to travel back to Omaha, Nebraska, long before the world knew him as the Oracle of Omaha. Warren Buffett was born in 1930 during the Great Depression, one of the toughest economic periods in American history. While most children worried about school, Buffett was fascinated by money. At just 6 years old, he bought packs of Coca Cola and sold each bottle separately for a small profit. The money wasn't life changing. The lesson was: small profits, repeated consistently, can create extraordinary results over time. At the age of 11, Buffett bought his very first stock. He watched the price fall almost immediately. Like most beginners, he panicked. When the stock finally recovered, he sold it for a small profit. A few months later, the same stock multiplied in value. That single mistake taught him a lesson that would shape the rest of his life. Patience often pays far more than emotion. As a teenager, Buffett wasn't interested in spending money. He was interested in multiplying it. He delivered newspapers, sold used golf balls, operated pinball machines, and even prepared tax returns. Before finishing high school, he had accumulated savings worth well over $100,000 in today's money. Most teenagers dream about buying a sports car. Buffett dreamed about buying businesses. But talent alone wasn't enough. He needed a mentor. That mentor was Benjamin Graham, the man widely regarded as the father of value investing. Graham introduced Buffett to a simple but powerful idea: a stock isn't just a ticker symbol on a screen, it's ownership in a real business. If that business is worth far more than its market price, buy it. If it isn't, wait. Simple in theory, incredibly difficult in practice. Because waiting feels unproductive, and most people hate waiting. But Buffett discovered that doing nothing is often the smartest investment decision you can make. After working under Benjamin Graham for a short time, Buffett returned to his hometown of Omaha with a clear vision. He didn't want to chase quick profits. He wanted to build lasting wealth. In 1956, he launched Buffett Partnership Limited. With just over $100,000 from a small group of family members and friends. Buffett invested only a small amount of his own money, but he brought something far more valuable: trust. Instead of collecting large management fees, Buffett structured the partnership so he earned more only when his investors earned more. Everyone's success was tied together. Over the next 13 years, the partnership consistently outperformed the stock market by a huge margin. People assumed Buffett had discovered some secret investing formula. He hadn't. He simply refused to overpay for businesses. Then came one of the strangest turning points in financial history. A struggling textile company called Berkshire Hathaway. At the time, the business was in decline. America's textile industry was shrinking, profits were falling, and most investors wanted nothing to do with it. Buffett initially bought Berkshire shares for one simple reason: they looked cheap. But then something unexpected happened. The company's management offered to buy back his shares at a certain price. Later, they lowered that offer. To many investors, it seemed like a small disagreement. To Buffett, it was a matter of principle. Instead of selling, he started buying even more shares. Eventually, he gained control of the entire company. Ironically, Buffett would later describe buying Berkshire Hathaway as one of the biggest mistakes of his career. Not because the company failed, but because the textile business itself had very little future. Yet sometimes history is built on unexpected mistakes. Rather than focusing on textiles, Buffett transformed Berkshire Hathaway into something completely different: a holding company. Think of it as a giant financial umbrella. Under that umbrella, Buffett gradually added insurance companies, railroads, energy businesses, manufacturers, retailers, and investments in some of the world's greatest public companies. One company, dozens of outstanding businesses. One strategy, exceptional capital allocation. This was the moment Buffett stopped being known as just a brilliant investor. He became a business builder. But the real breakthrough was still ahead. It came through an industry that most people consider boring: insurance. At first glance, insurance seems simple. People pay premiums. Some people file claims. The company pays those claims. End of story. But Buffett noticed something almost nobody else fully appreciated. Insurance companies receive cash today, yet many claims are paid months or even years later. During that waiting period, the company controls billions of dollars that haven't yet been paid out. This money is called insurance float. Most insurance companies invested that float very conservatively. Buffett saw a once in a lifetime opportunity. If the insurance business was run carefully and profitably, that float could be invested in exceptional businesses for many years. It was like gaining access to enormous amounts of investment capital at an extremely low cost. Over time, Berkshire's insurance float grew from millions of dollars to well over $100 billion. Suddenly, Berkshire Hathaway wasn't just selling insurance, it had built a financial engine capable of buying the future. And that single idea changed everything. With Berkshire Hathaway's insurance businesses generating a powerful stream of investment capital, Buffett's real advantage finally came into focus. Most investors spend their lives searching for the next hot stock. Buffett spent his life searching for great businesses. The difference may sound small, it isn't. Most people ask, which stock will go up next month? Buffett asks, will this business still be strong 20 years from now? That single shift in thinking changed everything. Instead of chasing trends, he looked for companies with strong brands, loyal customers, reliable profits, and durable competitive advantages. Businesses that people would continue using year after year. One of his most famous investments was Coca Cola. In 1988, after the stock market crash, fear dominated Wall Street. Many investors stayed away. Buffett saw opportunity. He believed that decades from now, billions of people would still be drinking Coca Cola. He invested about $1 billion. Time proved him right. The investment generated billions of dollars in dividends, while the value of Berkshire's stake multiplied many times over. Years later came another surprise: Apple. For decades, Buffett avoided technology companies because he invested only in businesses he fully understood. So, when Berkshire began buying Apple shares in 2016, many people were shocked. Had Buffett changed his philosophy? Not really. He simply realized that Apple wasn't just a technology company. It was one of the world's strongest consumer brands, with an incredibly loyal customer base and an ecosystem that kept people coming back. He adapted when the facts changed. Yet, despite becoming one of the richest people on earth, Buffett still lives in the Omaha house he bought in 1958. No giant palace, no fleet of luxury yachts, no obsession with showing off wealth. His lifestyle reflects the same philosophy that built his fortune. So, how did Warren Buffett become a billion-dollar business? He built a system, he bought exceptional businesses, he allowed time to do the heavy lifting, and he understood a truth that most people spend their entire lives learning. In the end, Warren Buffett